It was not a bubble popping. And it was not proof that silver suddenly became overvalued. That may be what the headlines suggested, and I understand why it felt that way watching prices fall day after day. But over the last week, I went deep into the data most retail investors never look at, and what I found completely changed how I view this move. That may be what the headline suggested, and I understand why it felt that way watching prices fall day after day. But over the last week, I went deep into the data most retail investors never look at, and what I found completely changed how I view this move. This crash was not caused by people who understand silver deciding to sell it. It was caused by people who were gambling on silver, with borrowed money being forced out of their positions. Once you see the evidence, you will never look at a silver sell-off the same way again. Welcome to the hidden economy. If this kind of analysis is what you've been missing, subscribe. I break down what mainstream financial media won't touch and drop silver to the moon in the comments so I know this community sees what's happening. Let me start with something that took me far too long to truly understand about the silver futures market, and I think most investors still don't. On COMEX, the main US silver futures exchange, traders can control an entire silver position using as little as 5% of their own capital. The other 95% is borrowed. That's roughly 19-to-1 leverage. Put simply, if you have $1,000, you can control nearly $19,000 worth of silver. If silver rises 5%, you double your money. If silver falls 5%, your entire position is wiped out. And when that happens, you don't get to wait for a rebound. The exchange forces you out. That's called a margin call. Now here's where it gets important. When many traders are using high leverage, a small price drop triggers forced selling. That selling pushes prices lower, which triggers more margin calls, which forces more selling. It becomes a mechanical cascade, completely disconnected from whether silver is actually worth less. That is exactly what happened from $121 to $64. Margin requirements were raised in stages, from 5% to 8%, then to 11%, then 15%, and eventually 18%. Each increase forced another group of overleveraged traders to either post more capital or liquidate. Most couldn't post more capital, so they sold. Each wave of selling pushed prices lower, making the next wave of margin calls even more destructive. It was a self-feeding liquidation cycle. Think of it like a crowded theater where someone yells, "Fire." People aren't leaving because the movie is bad. They're leaving because everyone else is rushing for the exit. The movie, the fundamentals, never changed. The building, the physical silver market, never collapsed. What you saw was a stampede. Now let's look at the proof. I pulled COMEX Silver open interest data. Open interest measures how many futures contracts are currently active. At the peak, open interest reached about 176,000 contracts. After the crash, roughly 137,000, that means about 39,000 contracts were wiped out. Those weren't long-term holders calmly taking profits. Those were leveraged positions being forcibly liquidated. And this is why the crash was bullish beneath the surface. When weak hands leave, strong hands remain. The traders still holding silver are the ones with real capital, real conviction, and no need to panic on a 5% move. The market didn't break, it cleaned itself. I also noticed something else. Many traders exited around the $50 level. That's not random. $50 marked the highs in both 1980 and 2011. For 50 years, it was the ceiling. So when silver fell back through that level, it made sense psychologically for traders to lock in profits. But if silver now holds above $50, $60, or $70, those same traders have every reason to return as buyers. That's not bearish. That's sideline demand waiting for confirmation. Next, I wanted to see if this was just a US phenomenon, so I pulled China's silver futures data. Same pattern, same surge in leverage during the rally, same collapse during the crash. This wasn't one market malfunctioning, it was a global leverage flush. Then I turned to the physical market, and this is where things got interesting. I looked at London silver lease rates. London is the largest physical silver hub in the world. Lease rates represent the cost to borrow physical silver short term. In a healthy market, 1-month lease rates hover near zero. Anything above 1% signals stress. Right now, lease rates are around 4.5%. That's not normal, that's extreme. Just 2 years ago, lease rates were flat at zero. Today, professionals are paying historically high rates just to borrow silver for 30 days. So while paper prices were collapsing, the physical market was screaming scarcity. And there's more. I examined the 1-year silver swap rate relative to US interest rates. In a normal market, silver for future delivery costs more than silver today. That's called contango. But right now, silver is in deep backwardation, meaning buyers are paying a premium to get silver immediately rather than wait. The spread is around negative 3.5%. That's not subtle. That's desperation for physical metal. Then I looked at inventories. COMEX inventories continue to stair-step lower. Shanghai inventories have collapsed from over 1.2 million units to around 350,000. Vaults are draining, not refilling. So ask yourself this. If silver demand collapsed, why are inventories falling? If the bull market ended, why are lease rates exploding? If nobody wants silver, why are buyers paying premiums to get it now? The answer is simple. The crash wasn't about demand. It was about leverage. Here's what actually happened. Silver rallied hard. Speculators piled in using extreme leverage. Volatility rose. Margins were raised. Forced liquidations began. Leverage was flushed out. And now? Open interest is low. Speculators are gone. Physical demand remains strong. Inventories keep falling. Lease rates stay extreme. Price dropped, but the underlying tightness increased. That's not weakness. That's compression. In commodity markets, this matters. Unlike stocks, lower prices don't scare off physical buyers. They accelerate demand. Industrial users don't care about RSI. Mints don't care about futures positioning. They see lower prices and buy more. That's exactly what the data confirms. Now, 3 quick messages. If you sold during the crash, look at the physical data, not the headlines. Ask yourself whether this looks like a market breaking down or a paper price disconnecting from reality. If you held through it, the data says the foundation never cracked. And if you've been waiting on the sidelines, understand this. The mechanism that caused the crash is largely exhausted, while the forces that drive silver higher remain intact. Based on the data, the $70 area has a strong probability of becoming a structural floor. There simply aren't enough leveraged positions left to create another cascade like the one we just saw. I'm also watching the risks. If lease rates collapse, backwardation disappears, or inventories rise meaningfully, the thesis changes. But today, none of those conditions are present. One last thing. Mining stocks are still priced as if $50 is the ceiling. If the floor has shifted higher, miners are mispriced, and repricing could be violent. Bring it all together. Vaults are draining globally. Governments are labeling silver as strategic. Leverage has been flushed. Physical stress is rising. The crash wasn't the end. It was the reset. 5 years from now, this will be studied as a textbook example of how futures markets can temporarily disconnect from physical reality. The paper price fell. The physical market tightened. That's the signal. The speculators are gone. The metal is still disappearing. The question isn't whether silver recovers. It's whether you're positioned when it does.